Everybody good?
Yep.
I'm going to admit everybody now.
Hello, and thank you for joining our Q2 2026 market and economic update. My name is Paolo LaPietra. I'm going to be one of the presenters today, along with my colleague Edward Wilhelm. Ed, if you want to change the slide. Thank you. So we're going to be taking a look, as our agenda today, Ed's going to be spearheading our economic overview. We're going to be talking about oil, inflation, labor, the Fed, and GDP. Then I'll be taking things back over and I'm going to be doing our market and AI outlook, really specifically taking a look at earnings and valuations and where we sit right now within the markets and the economy, and then just kind of summarizing everything up, just seeing exactly where we stand within markets and what exactly we're specifically watching going forward. So let's talk about some specific portfolio positioning. On the left, you'll see our strategic overweights. I want to start off with US equities. We continue to have US equities only within the portfolio. And there's a multitude of reasons that go into that we'll go over today in today's presentation. But a lot of it has to just do with a lot of the strong inflows we're seeing, not just obviously in the US, but globally with a lot of the AI concentration that we're seeing within the US. And again, that's with the strategic growth overweight as well, just led by chips, memory, and infrastructure, all tied into the AI trade that we started back in last year and continue to add legs into that every quarter. And then for our underweights, we continue to have no specific international exposure within the portfolio. The reason I say specific, we do have some positions within our chip and AI trade that have some international exposure, but no international specific. And again, that's by design. We'll get into performance and the reasoning behind that. No sector specific, so you won't see any financials or consumer cyclicals or anything like that in the portfolio. We continue just like some thematics for our tactical overweights. And then finally, underweight on short duration bond. And, Ed will talk a lot about where we see the Fed taking rates and why it's been strategic to really have some more core exposure and add on that duration in this interest rate environment. And then let's take a look at some market performance. So right here on the right, we'll look at all the major indices we always like to track. We'll see the S&P 500 year to date up 10.9%. The tech heavy NASDAQ leading the charge here, up 12.7%. Obviously, a lot of that fueling that AI trade. Dow Jones Industrial Average up 8.9%. And then the developed international only up 8.3%. So a little bit of a shift compared to what we saw last year. International really leading the charge. We're seeing that reversion back to the mean of US. And again, we'll talk about why that is and why we see that and what we see going forward. And then finally, we have the US aggregate bond index flat on the year. Just a lot of interest rate movements and expectations of where Fed's going to bring rates. And again, don't want to steal Ed's thunder too much, but we're seeing bonds flat on the year. So on the next part of the presentation, we're going to pass it off to Ed.
Yeah, awesome. Thanks, Paolo. I'm going to be jumping into just a little bit of an economic backdrop. So, how could we not start with oil? Oil was really the swing factor this quarter, and it's something we continue to monitor closely. The US-Iran conflict since late Feb has disrupted the Strait of Hormuz, which has about a fifth of global oil flowing through it. It spiked just shy of 120 in late April, which we were all feeling at the pumps. And now, more recently, we had a summer ceasefire, which pulled it back to the low 70s. Now, as of the end of last week, over the weekend, re-escalating as the U.S. reimposed a blockade plus a 20% cargo fee. This pushed crude back up near 80, Brent around 86, and I think it's trading a little higher as of this morning. Now, funny enough, I actually also just read this morning is that we have abandoned the 20% cargo fee. And honestly, this dynamic of changing policy and constant headlines sums up the story of this oil shock. It's made it tough to monitor, and it's not really a question of if it will resolve, but just when. And it's important to remember that energy is a input cost to almost everything and remains a core driver to inflation, which is where we're heading next. And I actually have some good news on the inflation front. We got a print yesterday, and the data showed cooling in June by more than expected. Headline CPI fell from 4.2% in May to 3.5% in June. This is the biggest monthly drop since 2020, which was almost all gasoline, down around 10%. Now, if you look at core, which strips out food and energy, this eased to 2.6%, confirming that this really was an energy story, not broad price pressure. Now, the caveat is that this was June data before the oil jumps back up this week. So we may see some of that relief reverse, but again, time will tell. We also know that inflation is only one half of the Fed's mandate. Jobs are the other. Now, looking at the labor market, the story remains broadly the same. The labor market is cooling, but in an orderly way and not breaking. Unemployment has drifted from 3.5% up to about 4.2%. This is a gradual normalization. June added just 57,000 jobs, which was the weakest in 4 months, and the 2 prior months were revised down by about 74,000 between the two. A softening job market is the main argument against the Fed raising rates, even with inflation above target. Now, there's also an AI angle to this job story that's worth taking a look at. Some interesting data coming out of the Financial Times pushes back on the fear that AI is destroying jobs, at least so far. The study splits firms by AI spending. The heaviest spenders grew headcount by about 10%, while the lower adoption firms were flat. This is even more exaggerated for entry-level roles, where the effect is larger, about 12%. Now, this is the opposite of the hollowing out junior jobs worry. Now, it's still early, and this is the AI spending leaders, but so far, adoption comes with hiring, not cuts. When you put the hot, then cooling inflation along with the softer job market together, you get a Fed that's in a tough spot. Yesterday's soft inflation print cooled the Fed's hawkish tone. At the previous meeting under the new Fed chair, Kevin Warsh, they had held rates and leaned hawkish towards price hikes, caught between inflation and a softening job market. For the July 29th meeting, markets now see an 86% odds of a hold, and a hike is essentially off the table, with September showing about a 50-50 chance between a hold and a hike. But it's important to remember that this is just a snapshot, and these probabilities are reactionary to any data coming out. With that being said, there are no cuts priced in for 2026. This is a higher for longer environment that we're all familiar with. And what this tells me, no pun intended, is that there's still some gas left in the tank if we see inflation cool alongside the stable labor market. This would bring back some rate cut expectations and provide a tailwind to markets. And with that good news, through all of this, the economy is still growing. Despite the oil shock, the inflation swings, and softer jobs, the economy is still expanding. Growth rebounded to 2.1% in Q1 after a soft end to 2025. And the quarter-to-quarter noise is really mostly just trade and inventories. The consumer remains the engine of the economy. The Fed sees around 2.2% growth for the year, slower but durable, not a boom and not a recession. And that's the backdrop. I'll hand it over to Paolo to take a little bit of a deeper dive into market and the AI outlook.
Sorry about that. Little technical difficulties. Look like I couldn't come off of mute, but thank you, Ed. That was a great update. So, folks, I'm going to be covering the market and AI outlook. And where I want to start this story is taking a look at some valuations. So here we're taking a look at the AI valuation trade, and obviously that's super important. As we look back, the last, say, 3-4 years, really, the market has been so focused around exactly what AI is doing, what's powering, the S&P 500 and where we're going to be looking going forward. So where I want to break up this conversation here is into 2 charts that we're looking at on the left. The first one all the way to the left is AI-related industry performance. So what this chart is going to do is going to show us what the five major sectors of the AI trade, which is hyperscalers, semiconductors, hardware, power, and software, how much they make up the S&P 500's performance. And what we'll see is those five, subsectors of the AI trade power almost 52% of the S&P 500's performance. That's a lot. That's a high concentration. I understand the concerns around that of how concentrated that trade could be. But if we then take a look at the chart to the right, this is showing year over year earnings growth for those same five subsectors of the AI trade. Again, hyperscalers, semis, hardware, power, software. And what we'll see is double digit return all north of 20% multiples year over year. And what that shows us is that the earnings really justify not only the price performance that we've been seeing in AI, but really the concentration. It's the simple adage that we've been going back to time and time again when we've been, trying to navigate and invest in this market. It's follow the money. And certainly within the earnings multiples and the profitability expansions that we've been seeing in AI, this is where the money lies. The next thing I kind of want to talk about, and what's really been at the center of our investment thesis going back to November of last year, is this whole AI build out. And what this chart here on the left is doing is it's looking at all of the future data center lease commitments over the six large hyperscalers in the United States. That's Oracle, Microsoft, Meta, Amazon, Google, and CoreWeave. And what this shows us, if we look all the way to the right, as of Q1 of this year, they are forecasting over $850 billion in future capital expenditure in 2027. That's shovels in the ground, new data centers, new lease commitments that are powering all of the money that is flowing into what we're seeing right now in hardware and in chips. And again, so when we're seeing valuations increase and we're seeing performance really following in suit, we continue to see the flows into the build out within the AI landscape that makes us comfortable at the valuations that we currently sit at. And something else, Ed and I really have been discussing for the last few weeks as we think about the layers and the legs of this AI trade. Something that doesn't get focused in enough is the AI adoption, right? So we all know the large language models, everybody's talking about AI, using ChatGPT or using Claude. But the fact of the matter is, when you peel back the onion and you actually look at the US economy and all the sectors that make up the economy, which we could see here on the left, going all the way from information technology at the top to accommodation and food services, which is really just service businesses of our economy. There's a wide range of AI adoption. So obviously on the tech side, all the way at the top, we're starting to see some traction, about 42% AI adoption across the board. But on the bottom end, we're seeing very low AI adoption. And in total, right in the middle, we're seeing across the board of all sectors of our US economy, we're only seeing 21% of US firms using AI. Folks, this shows us we're 100% still in the early innings. And that really goes again into the thesis of how we're looking of this AI trade. We're in the early innings. We're in the build out. We want to be focused in on the infrastructure build, the energy build, the chips trade, really everything that's funneling into the data centers and the build out of this AI, really the foundational level. But as we see this AI adoption start to uptick, that is really going to be indicative to us that, hey, maybe this is where software starts to come back into favor, right? Maybe this is where we want to start to gradually make a transition out of the hardware space, more into the software space as we see higher AI adoption and higher profitability. And, really at this stage of the ball game within the software space, pretty cheap. Valuations are looking good. So this is one of the catalysts that we've been looking at to just really be the precursor of when we're getting comfortable on our software investments and where we want to take our AI trade next. Something else I wanted to touch base on, Ed talked about it earlier when we were talking about oil prices, but the fact of the matter is, obviously, we've been having an ongoing conflict within the Middle East, and that has certainly put some pressure on oil prices. So what I like to obviously do when we see some exogenous event like that is let's also take a look at it from a historical standpoint. Ed showed us where the oil prices were and how that can, make effects within to CPI and where that's going to take it from the Fed. But let's also take a look at what that historically meant for the S&P 500. So here on the left, we're looking at this chart that's looking at 8 different time periods, including where we are right now, all the way to the right. And it's looking at the S&P 500 forward year return after oil surged by over 20% over 2 days, which was exactly what we saw when we first got the news of the Iranian conflict. And what we'll see is on average, over those 8 periods, the S&P 500 returns 24% over the following subsequent 1 year. Now, all the way to the right, you'll see as of March 6th, we're actually down 1%. So I updated this all the way to the right. The S&P 500 is now up 12.5% since that March 6th date. So we've already started to see come into fruition is that positive S&P 500 return, but we're still only halfway from the median average that we've seen over the last 8 periods. Now, again, this is not the end all be all. This isn't our crystal ball that says we're guaranteed to see 24% over the next 6 months or so. But what it does show from a historical standpoint, aside from the economic data that Ed covered, and my focus here on where we're standing in this AI trade is just from a historical standpoint, certainly some gas left in the tank in the S&P 500. And then, kind of last but not least, we talked about how we're still US only. That's been the case, frankly, for the last, let's say, 8 years or so. And again, for a multitude of different reasons going back those 8 years. But a lot of the reason is just right now, we're continuing to see the most AI adoption and the most AI investments within the US. And the flows are showing that. So this chart here on the left looks at flows going into US equities going all the way back to 2022. And what we'll see is this kind of orangish, yellowish line is showing the 2026 flows. And you'll see that it's at, all-time highs from the last, 20 years or so, and it's above the 90% quartile. That means that not just obviously domestically are we seeing a lot of US investment into equities, but also internationally. And again, that just really has to go with right now, the US continues to be the leader in the AI trade and the AI adoption trade. And that's another catalyst on why we continue to be concentrated in US stocks only within our portfolios. So, folks, to summarize everything that we kind of discussed, Ed talked about the overall positive macro backdrop. We continue to see growth over 2% from GDP. That's a real positive. We're seeing inflation cooling, which is also great. We got June's data that looked positive, but Ed also pointed out, obviously, with the re-escalation, what's going on in Iran, that's something that needs to continue to be monitored as oil prices have been climbing over the last few days. And last but certainly not least on the macro side is the resilient consumer, right? Consumer continues to be in a healthy spot, super important. We talk about this time and time again on why it's important. Me, Ed, yourselves that are listening, we make up 70% of the US economy. So we need to be in a healthy spot, spending money in this economy to make sure that we continue to be pushing towards a healthier GDP number. Then Ed also talked about kind of the handcuff situation of the Fed, right? We've seen some CPI prices come down. We've seen stable labor. Potentially, there was some room to cut. But again, we've seen the re-escalation of the Iranian conflict. We're seeing oil prices come back up. So looks like July, we're going to hold off on any sort of rate hikes, still keeping the door open potentially in the second half of this year of a rate hike, maybe even a rate cut, depending on if we get some resolution and we continue to see oil prices come back down to $60 a barrel. We're still actively monitoring that to see if there's, a backdoor to potentially 25 basis point cut and, some point of Q4. Then AI outlook remains strong, kind of two-folded here. Talked about CapEx. Those numbers continue to be robust. We look at the 5 largest hyperscalers spending over $850 billion next year in the AI build out. That's really strong. Then we're still seeing very low AI adoption, right? Showing that we're still in the early innings of this AI trade. As we continue to see more US companies adopt AI, we're going to naturally see profitability expansion and earnings go up from there. So that's also should be a nice tailwind for markets. And then again, we're always going to come back to following the money and allowing the money to justify our investment cycle. And that's earnings justifying valuation. So we looked at, kind of 52% of AI companies powering the S&P 500 return so far this year. But then we actually looked at earnings growth, and we saw that across the 5 subsectors of the AI trade, multiple expansions across the board, all north of 20%. So really just the earnings justifying the valuations, and that's always going to be paramount for us as we continue down this path of this AI trade. So, folks, that's all we had for you guys today. Thank you so much for spending your afternoon with us. As Dave Clark would be very happy to hear, we have the important disclosure information here if you want to read that. And as always, anything that we covered today, if you want some more context, you want to take a deeper dive, reach out to your advisor, reach out to myself or Ed. We've been more than happy to kind of take a deeper dive into this. But folks, I hope you have a wonderful rest of your July, and we'll see you back next quarter.